waning. And again, that's going to help fuel our thought process when we're thinking about entries and exit points, taking profits, managing losses, managing risk. So instead of buy low, sell high, we might also, because we can do that within trend. A channel could be very wide. It could be at a low point within its recent range. And we could buy at the lower end of the channel, sell at the higher end of the channel. That's certainly possible. What we could also do is we could also buy high and sell higher. So we buy when it's trending, when it's showing strong momentum, because from a general idea, as a trader, we're not looking to bottom tick, top tick. We're not looking to call a bottom, call a tops. And we're going to talk about things like dips, which is really what those are. It's these moments where there's a pivotal decision being made by buyers and sellers, and there's these reversal points that really help us to form our decisions. So again, when we're trading around those different types of moments, again, we can have different perspectives. I'm assuming we're trading from a bullish perspective. If we're going to buy high, sell higher, we can buy when momentum's strong. Again, we can get a piece of the trend, a piece of the move. We don't have to get something from the very, very starting of a trend, because oftentimes we don't know a trend is there until we see some evidence that a trend exists. And as traders, we might make the assumption that if a trend is in place, there could be a reason why it's in place. The reason can be subjective, so it's not always super helpful to kind of have an argument as to the why. It might be good to have some kind of a knowledge of, could this be a macro? Could this be fundamental? Could this be purely technical? Well, the reality is it is what it is, right? To use a great ism there. But if we're trading price, if we're a chartist or a technician, we're going to use other types of concepts like confirmation. We're going to use things like volatility to know, okay, if we're looking at this key point, well, if it crosses that point by a penny, by a quarter, by a dollar, when do we know we're wrong? When do we exit? And there's a couple different ways we can think about that, because in addition to trading, in addition to looking for opportunity when we're trading, I should say, we also need a plan to manage defense, or to manage our losses and play defense. So again, the idea is we need to do two things: identify opportunity and manage risk. So for identifying opportunity, we start in our trading process by creating some kind of an outlook. That outlook means, what do we expect to happen? What do you think is going to happen? Have any of you out there created an outlook? Here's what I think is going to happen. And then you make a trade, and then you second guess yourself, you close, and darn it all, you were correct after all. You closed too early. That can be super, super frustrating. Or maybe you do a little research and you think, I'm pretty sure about this, and you create some kind of an outlook, and maybe you don't enter a trade. And then you put something on a watch list, you shelve it for tomorrow or next week, you get busy with work or something else happens, and you don't place a trade, you don't act on it. And then you check the news, and it was, wow, breaking news, XYZ happened. And that was the very thesis that you were researching and you were looking at. That's always very frustrating. So it's okay if we're wrong, but we don't want to be right and then still lose money on a trade. So in addition to creating an outlook, we want to try to avoid having a gut feeling. I will say it's okay, I think, and again, this is a stylistic aspect, so this is not a universal rule. I would say I use my gut sometimes too. I do empirical, quantitative, or chart-based analysis, fundamental analysis. And then after I do that, I ask my gut, what do you think? And sometimes that can be good, but I think you don't want to just rely purely on a gut instinct, because you want to have some data. You want to have something else that's telling you this is a good idea. You have a high likelihood of success, of making a profit. So in addition to having an outlook, we should be smart. We should be purposeful about planning entries and exit points. When I place a trade, I want to, again, for the sake of having a good defense, and for those of you out there who are sports fans, the NFL season's coming up pretty soon. In about a month or so, we'll be watching some football. I'm a big football fan. And a good saying in football, I forget which coach said this, but there's a saying that defense wins championships. And the idea is, when you have a good defense, it sets the bar low for your offense. If you hold the other team to one or two scores, Well, that's all you have to do to win is get one or two scores. And again, you just have to score more points. Pretty easy, right? Well, if the same process for trading is if we're really good about managing losing trades, we're trying to set the bar low so we have a high likelihood of being profitable and making money as a trader. So when I plan my entry and exits, and again, there's different techniques to doing that. We'll talk a little bit more about that. I want to set an entry point that is decent, that's reasonable, that's rational. I want to plan an exit point, both a profit target, in other words, what if I'm correct, what should I expect to happen? And in other words, how fast does that end up happening? When I'm wrong, I want there to be an area on the chart where I want there to be something that clearly tells me I'm wrong. I don't want to, again, going back to that gut feeling, I don't want to second guess myself. And actually, in trading, feel free to share this. It's actually so easy to second guess yourself. Have any of you out there placed a trade and then 5 minutes later, you're thinking, wow, what was I doing? What am I thinking? You want to really eliminate that because that will eat you up. It will keep you up at night. It is not a recipe for success. So when I set an exit point, I want to know if this happens, beyond a shadow of a doubt, I am wrong. I am so wrong, and I'm happy to exit. Usually I'll look at that as my max loss. And then I'll ask myself, am I comfortable with that max loss type of scenario? And is that going to do a lot of damage to my portfolio? It is a very present and real likelihood when any of you or myself or James, when we place a trade, we could very well be end up being wrong. And we need to plan for that and be prepared for that. Usually I'm going to have some soft, and again, this is more of a stylistic element, so you have to kind of develop this yourself. I'm going to have some soft exit points where I'm going to put my trade on I'm going to put it on alert, so to speak, for lack of a better phrase, where I'm going to say, okay, this trade is working against me. I'm going to be very careful about, do I have to wait until it hits that exit point? Can I, cut my weeds faster? Do I have to wait for them to grow before I start doing something? You always can. I don't think it's really a bad idea to cut a losing trade and not necessarily have to wait for a max loss scenario. But the idea is the thing you got to be careful of is, are you allowing enough time for your trade to pan out? Are you giving it enough room? Are you giving it enough volatility? I don't like to be, I'm not a parent. I'm sure many of you out there are parents. I don't like to be a helicopter parent with my trades. I don't like to, I want to give my trades a little bit of freedom and a little bit of wiggle room, but not so much where I'm being neglectful as a trade parent, so to speak, there as an analogy. So we want to give our trade plenty of time to pan out. And also, in terms of having soft exits with managing risk on a losing trade, I think we can also have soft exits in terms of managing profits on a winning trade. I might say, okay, here's where best case scenario, here's where I'm going to exit. If I'm correct, I'm going to make money. The profit target is going to more than compensate myself. If I duplicated this trade several times, if I was wrong a decent number of times. And we'll talk about ideas of reward to risk ratio, thinking about or considering the probability of success. And sometimes there can be a situation where, okay, let's say my full profit target is, $10 a share, whatever it is, $2 a share. Pick your number. Let's say it's $10 per share, and let's say you get $6 per share in a day. And let's say you expected your trade to last a month. Well, you got 60% of the move in a day as opposed to what you expect it to take a full month to pan out. So you're not going to go broke taking profits. But the thing you have to be careful of, just like we said, you got to be careful about giving your trade enough time with losing trades too, is that if you cut your winning trades too fast, and if you do that a lot, you're actually not letting your flowers grow, so to speak, in your garden. You're not allowing your winning trades to actually compensate you for the times you're going to be wrong. And by the way, it's inevitable. You will be wrong at some point. So you have to let your trades pan out. But sometimes, again, we can also think about the time-based aspect. So if I look at, okay, this trade could take a month. If I duplicated this trade and did it multiple times, I could replicate this trade, 12 times a year if it's a month time frame. If I get 60% of that profit target in a day, that could be really attractive. Again, just from a stylistic perspective. So just some thought processes there. We need to have discipline and patience because if we are hasty, if we are second guessing yourself, I can almost assure you, you're going to have a very difficult time being successful with trading. We have to have a process of managing trade-offs. That's what trading is. We're managing trade-offs. Nothing is free, right? If it was free and if it was easy, everybody would do this. It's difficult. And so we want to ideally try to make our lives as easy as possible. And we want to have a repeatable process. Trading is not, here's a formula, here's an exact metric I look at, here's an exact technical analysis. It's usually a general framework. What kind of opportunities am I going to look at? Am I going to follow trend? Am I going to do buy low, sell high? Am I going to use options? Am I going to trade volatility? Am I going to use spreads? Whatever the case is. And by the way, you can have a multifaceted approach, and I think that can do well for you as a trader so that you're not a one-trick pony. You're somebody that can have a lot of different choices in terms of what strategy or what technique you employ. Now, some of you out there may have preferences and say, hey, Troy, I'm very comfortable using a certain technique. I've only used that. And so that's how I like to trade. I don't think there's nothing necessarily wrong with that. But I think you have to know yourself. If I can go into philosophy for a minute, one of the things I've really kind of chewed on that's helped me with my trading, it's very popular in business school. If any of you have taken an MBA course, I'm sure you've probably read or heard of Sun Tzu, The Art of War. But it's an ancient philosophical piece of literature, one of the oldest in existence. And in it, of course, not everything is apples to apples to what we're experiencing today in terms of ancient Eastern styles and strategies of warfare. But one of the things Sun Tzu says in that ancient book or tome, however you want to call it, is he says you got to know two things before you go into battle. You have to know yourself and you have to know your enemy. If you know your enemy, but you don't know yourself, you will not be successful. If you know yourself, but you don't know your enemy, you will not be successful either. So you have to know both yourself and you have to know your enemy. So what I might say, how that could be an analogy for trading today is know yourself. What type of techniques do you employ? Where have you been successful? Where have you really not been successful? And you might have to be patient enough to wait for your opportunity. It's not always easy as a trader, kind of looking at screens, looking at a lot of news, thinking, I got to chase every single trend. Well, you got to chase your trend. You got to chase what's working for you. So I would encourage you by saying, make sure you're aware of your style, what's your comfort zone, and make sure you have a process that can be repeatable, duplicatable. You don't want to just get lucky once and say, hey, I had a great trade. Well, awesome, you had a great trade. What's going to be your next trade? Right? And is that going to allow you to be profitable if you employ similar techniques over a period of time? So those are some initial thoughts on a trading process. James, I hope I didn't get everybody bored to tears here, but I think we want to set the scene about having a process, creating an outlook, having a strategy, having some entry and exit points, being disciplined, having a duplicatable process. Once we have that in mind, we can then get into trend and say, am I trading a dip? Is this an inflection point? Is this an uptrend, a downtrend, etc.? So perhaps you'd like to chime in and take us further into this discussion here.
I think what you really covered kind of goes into a lot of the thought process behind just the planning of your trade and the approach that you're going to take. And that is going to be separate from just your own analysis from the charts. And that's kind of what this slide was very much about, just the ways that you're going to condition your own process to try to succeed in the environments that you're choosing to trade in. Of course, being the first one that we'll discuss is going to be the environment of the dip. So let me go ahead and share my screen here, although with this new update, it takes a little bit of a second here. So Hopefully my screen is coming through all right here. Troy, let me know if it's not, because I've been having issues with this perfect ever since we had a recent update. But the first type of environment, of course, in this case, we're going to be talking about two different types, the dip and the downtrend. So to make sure we're on the same kind of page, well, what is a dip? It's considered a temporary kind of pullback in price within a greater, longer term uptrend. So the key is we are still in an uptrend despite price declining to some area. And that area is going to be important because at what point does a dip become the next topic of the downtrend? So, what point does that pullback in price still retain that upward kind of bullish trend that you might be following? And that is really where technical analysis is going to be important. This is where you're expecting some type of pullback and it's going to be temporary. There's that phrase, the dip is your friend, unless it keeps on dipping. And because of the overall kind of overarching kind of theme of this trade, that longer term bullish trend, the strategies that are going to be applicable are going to be, as you guessed it, bullish strategies. Now, this session didn't have the options tag in the title, but it's still, I think options are very kind of valid tools that traders can use to try to profit and manage risk. So I do want to show a few kind of examples on how the different bullish strategies could result in kind of different risk and reward characteristics. So we're only going to spend, well, really just these few moments on this slide because, like with everything that we often talk about, I think it's helpful to go to the charts. And before I get to some of the symbols that were sent in, I want to kind of look at what could be viewed as a very kind of classic, guess we can say, example. So I'm sharing my Active Trader Pro screen kind of up here now, and we're looking at SPY. We could look at SPX as well, more or less the same thing, right? All that's really changing is the numbers on the right side and the symbol within the middle. Picking this because it is an underlying that many folks are familiar with. But there have also been some fantastic, I would say almost textbook examples of a series of dips within a longer term uptrend. And I think one of the best times to highlight was in the period after COVID. Now, part of identifying a dip requires you to identify an uptrend. How can you identify an uptrend? Well, I would say most of us can look at a chart, especially if you've been in at least one of our sessions before. You know, if price is going from left to the right and it's moving upward, well, that is an uptrend. Uptrends are characterized by peaks and valleys, and a kind of subsequently higher series of peaks and a higher series of valleys. Now, moving averages are great ways to let the computer do some of the work for us. This can tell us, based on the indicator, whether we're in an uptrend or a downtrend, based on that time frame that we've chosen. So I've got the very simple kind of three system set of moving averages, a 20 and a 50 and 200, which is somewhat kind of synonymous with the short-term, intermediate, and long-term trends. When did we enter an uptrend on this chart? I think it's safe to say that anyone would consider this area over here. And just to get a better view of this, I like to use the kind of the red boxes, right? At this point, almost anyone would consider this a downtrend. Price is underneath all of these moving averages. So at what point could we consider it an uptrend beginning? Was it when we broke the 20 and started trading above that? Possibly broke the 50, started trading above that? Or could it have been breaking above the 200 and started trading above that? Or could it have been when all of these moving averages were completely above the 200 in the order of the fastest above the slowest moving average? And when did that take place? When this 50 finally crossed the 200, which would have been around here. So when it comes to using at least this series of moving averages, there are three places where someone could say, we are now in a bullish trend, and they would be kind of very, I would say, kind of correct, depending on the time frame that they're looking at. Again, whether it's price above each of these individual moving averages, or when all of the moving averages are above each other in the order of fastest or lowest time frame, middle, and the largest or slowest time frame. And at this point here, they were in that order. When finally the 50 crossed above the 200s with the 20, 50, and 200 in order. So if this can help us identify an uptrend, then what do you think could help us identify a dip? Well, ideally, the same evidence that you're using for an uptrend will be also used to identify those dips. And SPY was a fantastic example during this period of time. And you can possibly see as we started trading above, we had a few periods of time where we broke underneath. But later on, we started to find ourselves in this situation. And just to maybe smooth out the chart a little bit more, what do you notice with price? Every time it hit this 50, it tended to bounce, right? We've got numerous examples, once, twice, three, four, five, six, seven. And it wasn't only until we get through it at this point here do we test it an eighth and a ninth time. And I think this could be just an example of when we're identifying an uptrend. We've created a bullish assessment on this based on, in this case, now I'm only using two, a short term and a longer term. So we've got our still, these are valid, our three different signals when the uptrend could be confirmed. The fastest, middle, slowest. We could say the slowest being the most valid. So when it comes to trading this, and let's focus on kind of the primary points, a dip trader would be going long in these scenarios. Anytime we were seeing price reach this. Now, we don't know, especially in the beginning, right? When we were looking at this chart, especially the first and the second time, we didn't necessarily know that this was going to be an area of support. Oftentimes, traders will want to find ideally three situations where support has been tested before it is considered a valid level of support. So in reality, it's at these later points, could they be viewed as actual buying opportunities? Now, that doesn't necessarily mean that you're out of any type of position, because this is still in a much longer term uptrend. More often than not, the strategies, the individuals that use this strategy is oftentimes investors that are putting capital when we get pullbacks. And some of these pullbacks can be fairly meaningful, right? 5% pullback at about a 3% pullback. Let's enable one more here that looked somewhat of large. From the peak, again, another 3% pullback. And these pullbacks are followed by rapid rallies in price. Not even giving ourselves from the intraday low, but imagine a trader getting in on the close. They have about a 5% movement in 10 days. We've got these two pullbacks here, right? Another 5% movement in almost 1 month. So in these scenarios, right, what are some good tools for traders, right? First things that we've done, we've identified the dip within this kind of larger series of uptrending environment. We have identified rallies that have taken place. They've been about 5% rallies. Interestingly enough, many of these had quite a long kind of rally. Some of them got as high as maybe 10% before the next dip. Some of them were fairly steep, as we can see in this case. That 5% rally was in the course of slightly over 1 week, both two movements here. So just to kind of put this maybe in a bit of an example of a few different ways that we could try to profit on this with a variety of instruments. I like to jump over to our P&L calculator. Now, this is primarily used for options trades for good reason, but we can use this even for a stock trade. But what I like doing this with this tool is comparing and contrasting the difference of strategies. So I'm going to use the current price just because I think it'll be easier instead of trying to conceptualize a price that existed prior to where we are currently. And with a 557, since we saw quite a few of those 5.5% moves, that's about a $30 movement in price. So I want to use current, pretend we were in that uptrend environment with the current price of SPY. And we did see that pullback and we wanted to try to profit. We could say buy 100 shares of stock, getting that current price. I'm going to add that here. And then going back over to the slides, in case not everyone caught that, right? A few different potential bullish strategies. There's a long stock, a long call, and even a short put. Let's add this. So we've got three different strategies. I'll save the multi-legs for more kind of advanced or intermediate sessions. But just these three different kind of strategies, three ways to try to profit on a dip and then further kind of rebound in underlying. So in addition to the long stock, we have a call trade. And I'm just going to do kind of 1 month out. August 9th is fairly close. And at the money kind of strike price, 557, a call, and we'll pay pretty much what it's asking for. And then let's add one more trade here because we're going to compare kind of three different ways to try to profit on this. Buy. I'll try this in this case. We're going to do that short put trade. Still roughly 1 month out. Same strike price, a put, and we're taking in that premium. So right down below, we've got three different strategies that we can try to formulate. And just to clean this up a little bit, as this isn't primarily a heavy kind of options session, I'm going to delete some extra columns here that, quite frankly, I don't think we'll need to look at it too much. So here we've got our quantity, one long contract, one short contract, 100 shares, our basis. This is our cost, right? 100 shares of SPY is about 55,000. One call, $843. And on the put trade, we actually took in a premium. That's why it is negative. And this is our P&L. So let's kind of go through in brief that example. So we saw back on SPY kind of a few different examples, and I purposely kind of focused on kind of those 5% movements and the amount of time it took, because kind of interesting. If you look at the angle, and we'll even include some of the earlier ones here, how long did it take to rally 5%? Took much longer over here. And we'll work with just these few. So the first time, end of January to, well, about the first week, maybe 10 days, 10 trading days. Here, 305, March 5th to March 15th, again, 10 trading days. Here we are, March 24th to the 1st of April, so maybe a week. And over here, 512, upwards of 614, so 1 month. So what I like to do is kind of compare and contrast, and this is why some traders might gravitate towards stocks or options. So what I can do over here on the left-hand side is add a price component. So if 557 and about 5 or 5.5% is around 30 points, I like round numbers. So let's say the market went up 30 points, about 5%. We were kind of emulating that same percentage move that we had seen in the past. That would bring us right at about $587. I'm going to click enter. What you're going to notice now is that theoretical profit and loss has changed down at the bottom. 2,400 on the calls, 2,900 on the stock, and that short put, only $541. But that was if it happened in one day, and we can't realistically expect one day's worth of movement. So what we can also use this tool for is to input the hypothetical how long did it take. So we saw a few examples, 1 week, 2 week, and 1 month. So let's play that out. If that 5% movement happened in 1 week, what would our P&L look like? Stock is made more, but option is fairly close, right? Everything here is profiting. What if it took us 2 weeks in that scenario? Stock is still made the most, followed by the call and the put. If we got that same scenario and it took us even upwards of 1 month, still, fortunately, profits all around. But as Troy was talking about earlier, right, risk is going to be crucial. Your job as a retail trader, first and foremost, is going to be to manage risk. Don't trade for the sake of trade. Trade when an opportunity that you feel comfortable with presents itself. So let's say it went down. What if that dip kept on dipping? And it happened, didn't it? Look in this scenario here, right? We got a pullback. And imagine if we had kind of entered a position, expecting a bounce as it had in the previous, maybe tried to profit around 5%. But what if it, say, kept dropping, maybe around 3? And we can see that here down below. Interesting risk and reward dynamic, though, right? Is that we've now lost the most on the stock, almost the similar amount on the put, but our call has been capped, right? It's at 818. It's not nearly as large. And what if it was over the course of, say, 1 month that we held on that long? We can see our P&L. So to remove the put and just show the long trade, this is where some of those options are considered somewhat favorable. Why? Because they can still provide you with profits. In this case, say SPY moves upward of, say, 587, 30 points up, right? Similar profits. You may say, hey, I'm happy with the profit either way, especially if it happens in a shorter term period of time, say 2 weeks. But if SPY starts dipping down 37 points, right, that loss is far smaller than what you're missing out on that upside gain. And we can say maybe worst case or best case scenarios, what if it kept going down, right? Instead of down 5%, maybe down 10, not really 10%, but about 10%. That loss just keeps increasing on the stock and it's remaining somewhat capped on the call. And the similar example, if we continue to rise in price appreciation, we make a better risk and reward from that call. So that's why when it comes to trading dips, right, buying the stock, maybe possibly putting on an option strategy can be advantageous. Now, I saw a few quick questions I'll answer, Troy, before I pass it back to you to talk about another kind of fun topic of the downtrend. BS, I saw your comment, right? How do we use the SMA? I would suggest, especially if you're intrigued by the simple moving averages, take a look at one of our kind of more kind of entry level technical analysis sessions, but within something like a blank chart here. You know what? Let me go to Microsoft. I saw, Christine, you gave us a Microsoft here, kind of in a fantastic, also kind of uptrend environment on Microsoft. But we can go to indicators and add our simple moving averages by either searching for it or typing in the box and then choosing our time frame. Usually 20, 50, or 200 is where a lot of folks start, with 200 being that longer term, but also can be viewed as a fairly reliable tool to know when a stock is in an uptrend or a downtrend. Simply, is the stock above the 200? That's a long-term uptrend. Is it below the 200? Well, it's a long-term downtrend. And just using that, can be a simple way. Now, I will show maybe this one more second, Troy, before I give you the chance. Christine mentioned Microsoft. Well, Microsoft has been in a kind of fantastic uptrend environment, and instead of using a moving average, right, you can also draw trend lines, and possibly you're seeing, right, why my eye is gravitating towards this. Well, Microsoft is at least defined by this trend line, right, currently in an uptrend. And it's filled with dips, is it not? Right? It still keeps moving up, but there have been these pullbacks in price. Now, they have been far larger than what we looked at on SPY, 9%, roughly 13%. But we can imagine if Microsoft were to continue on this uptrend, and even if now it went to reverse, right? It could still, a trader would have to make sure they're comfortable if price dropped to this maybe 6, 7, 8, 9, maybe 5%, depending on how quickly it gets down there. Would you feel comfortable going along with the expectation that this uptrend will remain? And in so doing that, make sure you have a plan if it does break this, because we know at some point it may not continue with this kind of uptrend. But Christine has a kind of a good example. This is more that present time series of an uptrend, in this case with Microsoft, filled with already a few dips, even starting in the very beginning, although I don't think anyone would be trading it. Why? Because we don't have enough evidence, at least for that uptrend, maybe right around here. It's only since around maybe after the summer of last year do we have the evidence of an uptrend. But Troy, I'll kind of end it there because I do want to make sure we have enough time to cover downtrends. Anything you wanted to add here? Maybe a question that jumped out. If not, I can let you introduce that next kind of outlook.
Yeah, there was another question also from Christine, just talking about kind of psychology of trading. And I definitely want to address that towards the end. Before we do that, let's talk about downtrends just so we can kind of cover the topic of the day. And James, stocks don't go up forever. They're not, oh, if they're trending, they're not always in an uptrend. It's not always sunshine and rainbows. So we can't always dip potato chips. Sometimes things are going to turn around and they're going to go in a different way. So one of the first symbols we got was of Disney. So I'm going to share a chart of Disney. So I'll go ahead, just grab the screen here. Hopefully everybody can see that. It's coming through nice and clear. So here's kind of a review of Disney going down memory lane here. This is, again, the drop out of COVID. A lot of stocks looked very similar. They had that precipitous drop and then that rise back. So if we just use this as a concept, and again, there's different trading styles. There was a question of using things like moving averages. I'm glad you addressed that, James, because they can be helpful for us for visualizing trend. I also think too, and again, this is just my opinion, use this for what it is. I also sometimes like to go back and forth using charts with a lot of indicators, with a lot of drawings. And I also sometimes just like to look at a plain chart with nothing on it. Maybe I have a couple lines here. I could even get rid of those. But maybe we want to use a little bit of both just so that we're not missing the forest from the trees. If we looked at this chart of Disney, what does it look like? Bottom left, top right, that looks like an uptrend, right? And you'd be correct. If we look at use a couple different drawings, we can see here, again, there was the question of, okay, what kind of time frames do you look at? And it's going to depend for everybody who's different. I think you should start kind of broadly looking at a lot of different data, a lot of different time, and then decide, do I want to trade a very small piece of the trend? Do I want to trade a bigger piece of the trend? And you might ask yourself, which is better? Well, it's going to depend. There's less turnover in your portfolio. Maybe that's something from a tax perspective that's more attractive to you. Maybe you're comfortable waiting and evaluating. Maybe you don't want to trade as much. Maybe you want to use something like an option strategy that you shared, James. A lot of options tend to be traded in that shorter term window in terms of kind of maximizing annualized gains. From an option selling perspective, it can be very attractive as well. So again, there's different kind of thought processes there. So with Disney, what I've done is I've kind of circled some of these key pivots or reversal points. And green pivots are positive pivots where it was arguably a very bullish signal after we got it. And again, we can't predict pivots. We wait to see them and then we plan afterwards. So a green pivot is a bullish pivot, a red pivot is a bearish pivot. And if you combine red and green, I believe it's yellow, but yellow doesn't show up too good in our chart. So I'm going to use orange here. So let's say we were trading Disney in a nutshell, right? Here's the start of your trend. We don't know it's the start of our trend. That's why I'm going to put it orange because it's a pivot. It's in the bullish direction, but we don't have really any framework other than just it's a recent pivot. We don't have any concept of trend necessarily yet if we're just looking at a bear chart. So again, it goes up. Here's an uptrend. James, you already talked about this. Here's another pivot, a straight line here, 2 lines or 2 points. We can use a straight line to connect that. We have a breakout. We have a push. Here's another pivot. It's connecting now a new line, a stronger aspect of trend. So we're still in this concept of trend, but we're now in a stronger point of the trend. Hey, a higher slope means the trend is stronger. It's going up faster. It still has a correlation between time and price, but it's going up faster. A lot of times, stronger trends are less sustainable because they're going fast. We know things can't go up forever necessarily. So, usually the more dramatic the slope, the more intense the trend. However, arguably it may not last as long. That's a little bit subjective, but that's just my opinion there. So here's a bear chart. Again, a bear being it's no indicators on it. If we throw indicators, again, the indicators are meant to help. They're not telling you anything necessarily you don't already know by looking at a chart. So if we throw on some indicators, I have a couple different things on here. It's a little bit messy. I have a 20 period moving average. I have a 100. I have a 200 moving average. And I also have some Bollinger Bands. And then I have a MACD understudy. So what does this all mean? I have a concept of short-term trend. Let's call that 20. I have a concept of medium-term trend. It's a 100 moving average. Could I use a 5 or a 10 for my short term? Yeah, I could. Could I use a 50, a 70, a 75 for my medium term? Yeah, I could. My 200-day moving average, the green line, that's my long-term concept of trend. Could I use 150? Could I use a 250? Yeah, you absolutely can. There's nothing necessarily magic about these numbers, but it's a visual aid. It's something that's going to kind of give you additional confirmation of your work, of your thesis. Bollinger Bands are a volatility indicator. It can also kind of be used momentum like too. So there's a little bit of overlap. And then I have a trend slash momentum hybrid indicator, which can help me with the ideas of trading with momentum in trend. And again, some people might use momentum reversals to trade in trend. So there's different kind of thought processes there. So again, uptrend, Disney gets a bounce. If we throw on the earnings flag, you can see this was right leading up to an earnings. Now, again, we're not talking about uptrends, James. You already talked about that. How about downtrends? So what happened is eventually there's going to be a point where it doesn't go higher anymore, and that was this point. Now, again, we didn't know that was the top until it happens. We do host a session called, trading tops and bottoms or spotting tops and bottoms. And one of the things we talk about is sometimes momentum can diverge. Momentum slows down as price is going up. The trend is still there, but it's slowing, it's weakening. Was there any sign of that here? There absolutely was. Here's a high. This was a new high. Momentum was lower. So there was a divergence. There was something that was telling us that, hey, it's slowing down. Just pay attention. It should reignite. It should continue with strength. Be careful if trend starts to break. Well, if we watched Disney, that's absolutely what started to happen. Here was another area where it bounced. It was actually higher than where we were before. Now, even though the price goes sideways, we've broken a concept of trend. We don't have this concept of trend anymore. It's broken. It's gone. Now, if we take this trend line, let me extend to the right here, and it's still intact. So again, a longer term concept of trend is still intact, shorter term, no longer there. How is that going to inform your trading process? It's going to depend on your timing and what type of strategies you employ. Okay, now we don't know it's a downtrend until we start seeing some additional data. Here's a point where we have earnings and we have a red candle. Okay, well, that wasn't necessarily a be all end all. We don't really know after we see that pivot, that's bearish, but we'd want to wait for new lows. Definition of an uptrend, higher highs, higher lows. definition of a downtrend, lower highs, lower lows. Well, we didn't really get a lower low yet, but we did get another data point in the downtrend. Now it kind of traded sideways. Again, it tried to take off. It tried to go outside, tried to push to the upper side of the bands. You can see the bands are starting to narrow. Volatility is compressing. There's a calm before the storm. We form another lower high. This is a very bearish signal. Big red candle. We're still holding on to this area, but what are we doing? We're now breaking this concept of trend. We're under our 200-day moving average. So there's multiple things that are telling us, pay attention, something is changing. And so warning sign after warning sign, what happens? We eventually break this concept of trend. We hold, we hold, we hold. The bulls are holding on. We have an earnings report, another lower high, and then we gap lower. Now, if I rewind a little bit, again, we have the value, we have the advantage of hindsight. If you're in this situation, what do you do? What do you do when trend has clearly broke? Here was support. Support should hold. It didn't. Do you close? Do you wait for it to bounce back? Is it a fake out breakdown? Well, what you could do is you could say, all right, this was a clear move. Again, the bands were narrowing. I'm going to slide here just to the right, just so I can see the first candle or so. I'm going to do it just, all right, there we go. So the first candle, outside move. So it's outside the bands, right? There's your candle. There's your response. So that is a move outside of the bands, right? So volatility is compressing, price was compressing. We're starting to see concepts of a down trend form. That's called a wedge, right? You have lower highs, but you have stable lows. So both can't be right forever. Something's got to give at some point. So here's your gotta give. It didn't bounce back. Maybe you don't want to be a helicopter trader. Maybe you give it a day or two, give it some room, let it breathe, let it bounce back. Folks, it didn't bounce back. Couple days, what are you going to do? Do you close? Do you hold? This is why it's important to have defense. This is why it's important to manage risk. So you couldn't dip potato chip. It fell, didn't hold support. And then what happened? This was the start of a multi-year downtrend. And along the way, I'm going to extend this trend line out. I'm going to extend to the right. And you can see we are below our 200-day moving average. And by the way, a lot of these moving averages will line up with your trend lines. You'll notice that, hey, that longer term concept of trend is sloping. This is our new longer term trend. So if you're trading within trend, does this say go long and buy here? It absolutely does not tell you that. So could you make money by buying right here and then you sold when it went up a little bit? Yeah, you can make some money, but you had a very short time window to do that. The overall trend is lower, lower highs, lower lows. We go down for quite a long time. And when do we bottom? Well, we don't bottom for a while. Could you buy low, sell high right here? Well, you can, but what's the risk? The risk is that it's not the bottom and you're not buying low. You're basically buying a low and it's going to make a new lower low. And it did that here. It did that here. It did that here. So it's not telling you to buy the stock. It's not telling you to go long if you're following trend. Now, eventually, momentum's starting to pick up. Again, that's a divergence, right? You feel that it's going down, but it's going down at a slower pace. So that downtrend is weakening. Momentum's starting to pick up. So now what happens now? We're retesting. We gained a little bit of progress. We're still in the concept of a downtrend. We don't even retake our 200. And then again, we form basically a same type of low. And let's see how this pans out. Eventually, we find a bottom. And again, it's not always so clean in terms of forming perfect bottoms, which is really why if we're a trend trader, it makes sense to be patient. It makes sense to wait. Don't guess the bottoms. Let the bottoms tell you that they're the bottoms and then trade after. That's kind of the method of trend trading. It's not always the same methodology and approach to those who, again, buy low, sell high. They might be looking at fundamentals, looking at other things. But again, I'm going to go to here. Okay, so that trend line here, it held, it held, it held. What's different now? What do you see now? We're starting to trade above the 200. Okay, that's at least a positive sign. We're starting to develop some momentum. That's a positive sign. We need to hold and not form lower lows and lower highs. This is still a lower high. That's still not a super bullish sign. Okay, well, if we look at this area should hold. Is it holding? Well, for now it is. Let's take a look. And nope, it's not. It's still trending lower. We're going lower, 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 and eventually the low is in. So I'm going to fast forward because this is just, again, a lesson in time. That's more or less what I want to show here. I'm going to go out 5 years. I'm going to move our chart. Now, here is that longer term concept of downtrend. Folks, this was March of 2021. When did it fully break? It didn't really fully break until February of this year. That's 3 years. Do you want to hold a losing stock for 3 years? That's not only did you lose a lot of money here, it was trading as high as around 200 or so, and it traded down to as low as 80. You lost more than half of your money. You don't have to hold stocks that are going down. You have a choice. You can protect yourself. You can play defense, right? People say, oh, I want to hold because it's more favorable for taxes if I hold. Listen, if you lose $1 and you can write off 30 cents, you're still losing 70 cents. If you make $1 and you got to pay 30 cents in taxes, you're making 70 cents. So there's got to be a better reason for holding other than just, well, I'm being patient. It's okay to be patient. Patience is a virtue. But should we be patient by using a strategy that can help us be profitable? That might be a better utilization of our patience. There's different ways of looking at trend, things like reversal points, moving averages, support and resistance, and understanding things like volatility, momentum can help us trade within trend. And in this case study of Disney, basic concepts of trend. Folks, it was not fun if we rewind. It was not fun if you bought. And Christine, I'm now going to come back to your question because you had a great question that I mentioned earlier that I wanted to touch on. And you said, okay, sometimes I buy and it starts going down, and I'm second guessing myself. And I'm wondering, okay, should I give it more time? Should I be more patient? It's a great question, right? And sometimes, again, there's nothing wrong with being patient. But listen, if we bought up here, let's say you bought at 195. You were buying within trend. There's nothing necessarily wrong with that. Did you get a momentum divergence? You did. So there were some stuff telling you that things are slowing down. But again, you had to have some kind of a plan to say, okay, when am I wrong? And again, depending on your sizing, depending on your risk tolerance, time frame, other types of considerations, you got to have some kind of an exit point. Maybe you bought here around 195, and then maybe you saw this bounce right here and thought, hey, it's not perfect. It's kind of it's broke, but maybe it's going to retake. Well, it tries to retake here, and then it starts drifting lower. Maybe somewhere around here is where you closed. Okay, if you bought at 195 and sold at 180, well, it's $15 per share. That's about an 8-9% loss. If you didn't bite off more than you can chew, that may not be so bad. If you put all your money in one stock, that did some damage, so that's not a good idea. So again, if you did nothing but just buy here and wait for a much more dramatic sign, maybe you sold at 160. Okay, 195 to 160, that's a 35 per share loss. That's about 16, 17%. That's also gonna smart. But you know what's gonna hurt more? Holding and holding and holding as it drifts lower over 3 years and losing over half of your investment. It would have been better. Take one on the chin, move on, protect yourself because it's not always going to bounce back. Sometimes it doesn't bounce back. And what's the worst case scenario? The worst case scenario is not only does it not bounce back, it gets worse. Things can always get better, but things can always get worse. So you have to have a point in time where you say, that's enough. I'm done bleeding. I'm going to get out and I'm going to reevaluate later. Your second question, Christine, I think is another good one is you say, I'm afraid of selling for profitable trades because I'm thinking that I might have to buy back at a more expensive price later. So that is going to more be along the lines of what kind of opportunities do you look for? Somebody who says, I don't want to buy at a high price, in my mind, that's an investor kind of perspective, hey, I don't want to buy the same product for a higher price. From a trading perspective, we want to buy at a higher price. Why? Because we buy high, sell higher, because we're looking for trend, we're looking for momentum. So we're not really so caught up on the actual price. We're more caught in terms of what's the context of price. Well, if price is in a trend, I want to trade within trend. Again, there's different ways to enter. You can enter during some of these breakouts. You can enter during after a major pivot. You can enter during a pivot. It's going to be hard because you don't know that it's going to fully be a pivot until it happens. Here on the way up, what would have been a perfect entry point? Well, right here would have been a great entry point. That's a breakout. You're already in an uptrend. And now the uptrend accelerates. So you have a period where the trend was strongest. From a trading perspective, we don't need to pick the beginning. We don't need to pick the end. We want to get the meat of the move. A great analogy is if we're surfing, right? We don't predict when the wave is going to start. We don't predict ahead of time where the wave is going to crash. We wait, we see the wave forming, we get in position, we ride the wave, and then as it starts to crash, we start seeing some things and we glide off to safety, right? We don't have to pick the beginning, we don't have to pick the end. That's again a trend trading perspective. If you're an investor, well, you have to look at some other things. You have to look at valuation, growth, book value, revenue growth, cash flow, earnings. It's a lot to look at. We do host some sessions on fundamental analysis. It's a much harder discipline. That's debatable. I should say, maybe I'll rephrase it differently. There's a lot more things to look at. With charting is not necessarily easier, I should say, but there's some basic concepts that perhaps are a little bit more easier to grasp than going into things like forensic accounting or other types of methods there. So I know we're at time, James. I'm off my soapbox. Any last minute thoughts that you'd like to kind of chip in? Anything you want to pick apart that I said? Please feel free to give me some of your expertise and thoughts there, sir.
I know we're already a little bit over there. I just want to say, I know we weren't able to get to all the symbols out there, but we absolutely got some good ones. John giving us a Peloton who's been on quite a long downtrend. I think it was um, actually a few gave us Blago and Wayne giving us Nike also, especially after Nike's earnings. Uh, and that kind of downward move also right on a downtrend. And Tesla, Dave, I saw that you gave us a Tesla, currently a stock that for a while had been on quite a downtrend. Yes, it's selling off quite a bit today, but of course it still had quite a lot of momentum that had to possibly bleed off a little bit there. But we'll end it there. Well, maybe one other question I can answer here. Wayne, just because when you brought up when drawing trend lines, how do you select the best pivot and the best slope for the line? Oftentimes when drawing trend lines, I think one of the ways that it's best going to help folks, especially if you're new to it, just try to connect as many of those reversal points as possible and focus on the sheer number of them. Oftentimes, and when you're trying to find, is this trend line valid or is it important? Well, the more reversals, the better, the stronger it is, and the longer time that it is valid for, again, the longer it is. So if you could find longer term kind of trend lines, either up or down, or even horizontal, that have many points of contact, that is a good sign, right? The more the merrier when it comes to reversal points on trend lines, Wayne. So hopefully that helps at least getting started. But we will end it there. Hopefully you found this session right helpful, right at the very least informative. Maybe especially gave you some ideas when it comes to kind of trading in those downtrend or dipping environments, we should say, right? Uptrends or downtrends. And that is one of the benefits of being a trader as opposed to an investor, where investor, you're kind of stuck in there. You're just riding it out for better or for worse. Trader, you're meant to be more tactful, looking for those opportunities when they present themselves. But until next time, everyone, please be safe out there. Best of luck on any of those, maybe dipping or downtrend trades. And I hope to see you on another session, possibly very soon. Troy, good to be with you as always.